Hi, this is Becky Spain. Welcome to Lecture 3 covering Chapter 3 of Taxes in Your Financial Plan. Hey, we all know this. Taxes are just a financial fact of life. Don't wait until tax day, April 15, to start thinking about your taxes. Tax planning, like all aspects of your personal financial planning, should be an ongoing process. It starts with knowing the tax laws, maintaining good tax records, and knowing how to reduce your tax liabilities. That's what we're going to go over in this chapter. We start with a brief discussion of the types of taxes. The fundamental aspects of federal income taxes are presented next, including income tax, your deductions and exemptions, tax rates, and tax credits. The information on filing your federal income tax return covers filing status, types of forms, basic steps for completing the Form 1040, and then finally the chapter is going to conclude with a discussion of tax planning and how to reduce your taxes, which we all will love to hear. All right, so let's start by looking at our learning objectives for this chapter. Our learning objective number 1 is to identify the major tax types in our society. Tax planning can influence your spending, savings, borrowing, and investing decisions. It should anyway. And awareness of income taxes, sales tax, excise tax, property tax, estate tax, inheritance tax, gift tax, and Social Security taxes are all vital in your successful financial planning. So we'll touch on those. And then our objective number 2 is to calculate taxable income and the amount owed for federal income tax. Taxable income is determined by subtracting adjustments to your overall income, looking at what deductions are allowable and allowances for exemptions from your gross income. Your total tax liability is based on the published tax tables and tax schedules less any tax credits. So let's look at objective number 3. We're going to have as our third objective to prepare a federal income tax return. The major sections of the Form 1040 provide the basic framework for filing your federal income tax return. The main source of tax assistance are IRS services, IRS publications, other publications that you might find online, or other resources on the internet, computer software, professional tax preparers, accountants, and attorneys. And objective number 4 is to select appropriate tax strategies for various life situations. So you may reduce your tax burden through careful planning and making financial decisions related to what you purchase and how you use debt, investments, and even through your retirement planning. This chapter covers a lot of detail, so I'll try to move through as quickly as possible while hitting the highlights. I want to make sure that what we do tonight will add to your learning experience. Learning objective number 1, identify the major taxes paid by people in our society. So we begin with common goals related to tax planning strategies. And these include knowing your current tax laws, making sure that you are maintaining complete records, making financial decisions that can reduce your tax liability. Let's look at the types of taxes we pay. The first is the tax on our purchases. We all know that when we make a purchase, we pay state and local taxes. They're added to our purchase at the time that we make it. An excise tax is imposed by the federal and state governments on specific goods and services such as gasoline, cigarettes, alcoholic beverages, tires, air travel, and telephone services. We pay those at the time that we pay for those items as well. You pay taxes on property. The real estate property tax is based on the value of your land and your buildings. And then we also pay personal property taxes. They're due on the value of your automobiles, boats, furniture, and farm equipment. And they vary in an amount depending on where you live. You also pay estate taxes. This tax is imposed on the value of your property at the time of death. And then there's an inheritance tax. Inheritance tax is levied on the value of the property that is bequeathed to you by a deceased individual. And then finally, there's gift amounts. Anything greater than $14,000 is subject to federal taxes. So if someone gives you a $20,000 gift, you're going to have to pay taxes on the last $6,000 of that. And finally, you pay taxes on what you earn. Social Security taxes are used to finance the retirement, disability, and life insurance benefits of the federal government Social Security program. Income tax is the major financial planning aspect of taxes for most individuals. In addition to federal income taxes, all but 7 states also have state income tax. Objective number 2, calculate taxable income and the amount owed for federal income tax. The process of determining your federal income tax involves computing taxable income, calculating the amount of the owed tax, and comparing this amount with income tax payments withheld or made during the year. Now let's walk through the steps and the terms that you'll need to know to determine your adjusted gross income. There is a great exhibit in your book on page 79, and you might want to use this to follow along as we go through the steps. I think it will make these explanations a little bit clearer. Number 1 is to determine your adjusted gross income. Taxable income is the net amount of income after allowable deductions, and this is what your tax is computed on. Earned income is money received by an individual for personal efforts, such as your wages, your salary, any commissions that you've earned, fees, tips that you get, or even bonuses. Your investment income is money received in the form of dividends, interest, rent, anything that you get from any of your investments. Passive income is the result of business activity in which you do not actively participate, such as a limited partnership. An exclusion is an amount not included in your gross income, such as foreign income when you're working in another country. Tax-exempt income is income not subject to tax. Tax-deferred income refers to income that will be taxed at a later date. Adjusted gross income is your gross income after certain reductions have been made. And a tax shelter is an investment that provides immediate tax benefits and the reasonable expectation for a future financial return. Step 2 is computing your taxable income. A tax deduction is an amount that is subtracted from your adjusted gross income to arrive at what is your taxable income. What are you going to pay taxes on? Every taxpayer receives at least the standard deduction, which is a set amount on which no tax is paid. But many individuals qualify for more than just that standard deduction. They take itemized deductions, which requires you to itemize your deductions, what they are and the amounts, rather than just taking a standard deduction, which is just a one lump sum. You have to be able to prove what you've spent on these qualified deductions. So let's look more closely at itemized deductions. Itemized deductions are expenses that a taxpayer is allowed to deduct from your adjusted gross income, and they include such things as medical expenses and dental expenses above a certain amount, certain state and local taxes, certain interest payments such as your home mortgage, contributions that you make to not-for-profit organizations, casualty and theft losses based on certain restrictions, moving expenses under certain conditions, certain job-related expenses, and miscellaneous expenses. An exemption is a deduction from your adjusted gross income for yourself, your spouse, and any qualified dependents. Okay, so now we know how much money we've made. We've talked about what we're going to take out of our income as deductions and exemptions. In step 3, we'll calculate our taxes owed. So taxable income is the basis for the amount of your income tax. The use of tax rates and the benefits of tax credits are the final phase of your tax computation process. Use your taxable income in conjunction with the appropriate tax table and tax schedule. A couple of terms that you're going to need to know. The first one is the marginal tax rate. It refers to the rate used to calculate tax on your last and next dollar of taxable income. We also want to look at your average tax rate, because it is based on the total tax due divided by your taxable income. The alternative minimum tax was designed to prevent those with high incomes from avoiding taxes. And a tax credit is an amount subtracted directly from the amount of taxes owed. Tax credit is better than a tax deduction. If you have a tax deduction, you're reducing the amount of your total taxable income. So, the dollar amount for which you have to pay taxes at your set rate. However, a tax credit actually takes off the total amount. So let's say that after you have completed your income tax return, it shows that you owe $3,000 and you have an earned income credit of $1,000. That actually comes off of that $3,000 amount, lowering the amount of tax that you actually earn. So a tax credit is much better than a deduction. So in addition to earned income credits, there's also foreign tax credits, child and dependent care credits, saver's credit, adoption tax credits, and education credits. You want to make sure that you are familiarized with what these are and how to qualify for them, because you certainly don't want to miss being able to take one of these that you have earned. Step 4 is actually making your tax payment. The pay-as-you-go system was actually started in 1943, and it requires an employer to deduct an amount for federal income tax from the pay that they give to you and send it to the government for you. The withheld amount is based on the number of exemptions that you have and your expected deductions. The W-2 form reports your annual earnings and the amounts that have been deducted for federal income tax, Social Security, and state income tax. And low-income individuals may file for an exemption from withholding if you paid no federal income tax last year and you don't expect to pay anything in the current year. So even though your employer is required to withdraw those funds from your money before he writes the check to you for your pay, you can file for an exemption so that nothing is taken out of your check and you're given the total amount. However, some people who make additional funds, in addition to like a regular paycheck, may have to make estimated quarterly tax payments. So my husband did some work for a lawyer and reviewed some files for him, and then he billed him, and he was paid in addition to his regular work that he does full time. And we had to pay taxes using estimated quarterly tax payments on those dollars so that we wouldn't get in trouble at the end of the year for having made this extra money and not having paid taxes throughout the year quarterly on those dollars. So people with income from savings, investments, independent contracting, which was what he did, royalties, if you take money, a lump sum from your pension or your retirement plan, you need to be aware that there's a strong possibility you'll have to make estimated quarterly tax payments. Those are due 4 times a year. And if you make too much money in one of these ways and you don't file an estimated quarterly tax payment, then you can be penalized whenever you do file your income tax return. Which leads us right into step number 5, which is deadlines and penalties. We want to avoid penalties because they can be very harsh and very severe. The IRS is very unforgiving of people who do not follow the laws and file their taxes on time and pay the amounts that they're supposed to pay in a timely manner. So most people are required to file their income tax, their federal income tax, each year by April 15. If you are not able to file on time, you can file for an automatic 6-month extension. that this extension allows you to have additional time to prepare your taxes, but what people don't often understand is this does not allow you additional time to pay your taxes. So even if you are filing an extension, you need to make sure that you have your taxes for that year paid prior to April 15, or you can incur penalties. And like I said, IRS are not very forgiving. Penalties can run up to 50 to 75% of the amount that you owe. All right, so let's move on looking at learning objective number 3, which is to prepare a federal income tax return. The annual submission of federal income tax requires several decisions and activities. Every citizen or resident of the United States and every citizen who is a resident of Puerto Rico is required to file a federal income tax return if he or she has income above a certain amount. There are 5 filing statuses, and you must choose one. You must either file as a single person, as a married person, but filing a joint return or just one return, a married person, but you're filing separate returns, a head of household, or a qualifying widow or widower with a dependent. And looking at which tax form to use, the 1040EZ is for single people or people who are filing as a single, and you claim your own exemption. If your income consisted only of wages, salaries, and tips, and not more than $1,500 of interest. If your income tax is less than, if your taxable income is less than $100,000, and if you do not itemize deductions or claim any adjustments or tax credits, then you can use the 1040EZ. The 1040A would be used by individuals who have less than $100,000 in taxable income from your wages and salaries, tips, unemployment compensation, interest, those types of things. On the form, you can report a deduction for an IRA or an individual retirement account contributions and for tax credits for child care and dependent care. You would want to use a 1040 if neither the EZ or the A are the right choices for you. It is the most used form. It's an expanded version of the Form 1040A, and it includes sections for all types of income and makes it possible for you to actually itemize your deductions. The Form 1040X is used to amend a previously filed income tax return. So what is the process for completing the federal income tax return? Well, starting on page 87 in your book, it walks you through the process of completing the 1040 form. Use your book and the PowerPoint deck that's going to be provided to you to familiarize yourself with the steps on this form. And don't forget to file your state income tax return as well. All but 7 states have state income taxes. And states usually require income tax returns to be filed at the same time that your federal tax return is filed. Let's look at learning objective number 4, which is to select appropriate tax strategies. And I think that this is the most interesting part of the chapter because it talks about how to reduce our taxable liabilities, and that's certainly what all of us want to do. So the book talks about tax avoidance and practicing tax avoidance. Basically, what it's saying is that you need to figure out what you can do to reduce your tax liabilities in ways that are legal and effective. Your financial decisions related to what you purchase, your investments that you're making, and your retirement planning will most heavily impact your tax avoidance strategies. Tax avoidance is totally legal, and everyone should evaluate their personal situation to determine how best that they can use this practice. However, tax evasion is not legal. It is illegal. So make sure that you are reporting all of your earned income. Right consumer purchasing strategy can help you reduce your tax liabilities, such as owning a home. It's one of the best tax shelters available to most individuals. Real estate property taxes and mortgage interest are deductible as itemized deductions. The interest on a home equity loan is also deductible when these loans are used to buy a car, consolidate credit cards, or finance other personal expenses. A variety of work expenses are also deductible, such as your union dues, certain travel and education costs, business tools. These all may be itemized. A healthcare savings account, like a flexible spending account or an FSA, can also help you to reduce your taxable income. Pre-tax dollars are set aside to pay for medical expenses and dependent care costs. You can reduce taxes on earnings by choosing the right investment decisions. Interest income from municipal bonds, which are issued by state and local government, and other tax-exempt investments is not subject to federal income tax. Tax-deferred investments include tax-deferred annuities, Section 529 saving plans, and retirement plans such as an IRA or a 401k. Capital gains are profits from the sale of a capital asset such as stocks or bonds or real estate, and they're also tax deferred. You do not have to pay the tax on these until the asset is sold. Long-term capital gains are on investments that are held for more than a year, and they are taxed at a lower rate, while short-term capital gains are usually less than 12 months, and they're taxed at the ordinary rate. Most commonly used tax planning strategy is the retirement plan. Let's look briefly at some of the different kinds of retirement plans. A traditional IRA allows for contributions up to $5,500 a year. If you are over 50, you can put back $6,500 per year. Anything that is earned through your plan is not taxed until the funds are withdrawn. Today, a regular IRA deduction is available only to people who do not participate in employer-sponsored retirement plans and have an adjusted gross income under a certain amount. It's important to note that whenever those funds are withdrawn, though, you do pay income on them at that time. If you do not leave the funds in there until you're at least 59 and a half years old, you can pay an additional 10% penalty for withdrawing those funds, unless the funds are withdrawn on the account of death or disability, for medical expenses, or for a qualified higher education expense. You've probably also heard of a Roth IRA. In 1997, Congress created the Roth IRA. While the $5,500 annual contribution to this plan is not tax deductible, the earnings on the account are tax-free after 5 years. So the funds from a Roth IRA may be drawn after the age of 59 and a half if the account owner is disabled, for educational expenses, or for the purchase of your first home. As with the regular IRA, the Roth IRA is limited to people with an adjusted gross income under a certain amount, so not everyone qualifies for a Roth IRA. The Coverdell Education Savings Account is designed to assist parents to save for their kids' college fund. Once again, the annual contribution is limited to $2,000 and is not tax deductible, and is limited to taxpayers with an adjusted gross income under a certain amount. However, as with the Roth IRA, the earnings accumulate tax-free. If you are a self-employed person and own your own business, you can establish a plan, also called an HR-10 plan, may combine a profit-sharing plan and a money purchase pension plan of other investments. And then finally, the one that we're probably most familiar with is the 401k. So the part of the tax code that is called 401k authorizes a tax-deferred retirement plan sponsored by an employer. This plan allows a person to contribute a greater tax-deferred amount with a maximum amount of $16,500. And that is an older amount. I'm always hesitant to put dollar amounts because they do change from time to time. But anyway, you can contribute that to an IRA. However, most companies set contributions. They've set limitations such as 15% of your salary. And as a benefit, many employers provide matching or a partial matching contribution to your 401k plan. Cautious when going over this chapter with students because tax laws change so frequently, and even as I'm preparing this lecture, it's being reviewed again by our federal government, looking at what changes might happen. So this information is accurate at the time of this recording, but each year the IRS does change the tax form and the filing procedures, and it looks like we may have some fairly significant changes in the next few years. In addition, Congress frequently passes legislation that changes the tax code or the dollars that are allowable. These changes require you regularly to determine how to best take advantage of tax laws for your personal financial planning. But anything that you can do to reduce tax liability is certainly going to be in your best interest in the long run. So once again, I'll remind you that the full PowerPoint deck is available to you. It's posted for you. I'll also encourage you to take time to view the supplemental videos that have been posted, as these are designed to assist you in your learning process for this chapter. I look forward to seeing you all next week, and please know that I'm available should you have questions.